In the blink of an eye, 2025 is already drawing to a close. Throughout 2025 on Canada's covered call ETF battlefield, every fund company has been fighting to showcase the most explosive distribution yield, throwing everything they've got at it. As soon as 2025 kicked off, Harvest fired the first shot with HHIS, boasting a 25% distribution yield, and HHIC coming in at 20%. Evolve refused to be outdone and in September launched the ultra-yield namesake BIGY alongside Caney, and even teased 60 for November. Everything points at one metric: yield. BIGY's initial projection is a 30% annualized payout that looks like a dream package of effortless income. But a harsh reality sits right there. A high distribution doesn't automatically mean a sound structure. Many issuers, while chasing yield, to some extent have sacrificed the integrity of their fund structures. Today, I want to talk about BIGY, the ETF with a payout nearing 30%, and why my feelings toward Evolve's BIGY went from excitement at the start to disappointment once the details came out. Please also note this is solely my personal opinion. It doesn't necessarily represent everyone. Let's dive into this episode. First, let's look at BIGY's basic information and structure. BIGY sits within Evolve's ultra-yield lineup as an actively managed covered call ETF focused on U.S. equities. Starting with distributions, BIGY pays out twice a month, meaning the cash flow hits like a paycheck every 2 weeks. At roughly $25 per unit right now, each share pays $0.3125 and does so twice a month, for a yield just shy of 30%. It carries modest 1.33x leverage to amplify swings and charges a 0.4% management fee. Of course, that excludes leverage borrowing costs and trading costs. BIGY currently holds 10 equally weighted large-cap names because it's aimed squarely at the U.S. market. It includes the U.S. Magnificent Seven: Apple, Microsoft, Nvidia, plus Google, Amazon, Meta, and Tesla, then squeezes in Palantir along with high-volatility plays like Coinbase and MicroStrategy. One thing to note is that BIGY's portfolio isn't passively screened by market cap weighting. It's handpicked by the managers with their own taste and timing baked in, all to squeeze more option premium to support that payout. On the covered call front, Evolve pushed for higher income by raising the covered call coverage from its usual 33% up to 50%. Higher coverage does mean richer distributions, but it also means giving up far more upside. This structure directly pushes the annualized yield to 30%, but behind that setup is a cost we need to identify. That's what I'm about to dig into. Historically, Evolve's products like Bank, QQQY, and ESPX all relied on index rules for stock selection. BIGY, in order to enter the yield arms race, took the active management route instead of sticking with rigid index rules. Indexes come with transparent, inflexible rule screening by market cap and liquidity, clear financial thresholds, and fixed rebalancing schedules. BIGY and Caney, being non-indexed, lack defined entry and exit criteria. There are no hard clauses. When holdings change, it's mostly at the manager's discretion. You might say the current basket seems fine, the Magnificent Seven are all there, PLTR is riding high, and MSTR and Coin give exposure to crypto. But remember, individual stock profiles drift. This year's high growers can become slow-growing heavyweights next year, and new market darlings will keep emerging. Whether and when old holdings get swapped out depends entirely on human judgment. Take the crypto-linked names. If they earned a spot via market cap rules, I'd accept that as an index outcome. In reality, the managers added MSTR and Coin deliberately to juice cash flow. That's a stylistic choice, not rule-based. You think you're buying rules, but you're really buying people, and people make mistakes and drift off course. Let's look at a quick comparison. Because BIGY is new, it lacks enough data for a fair matchup. So I'll use Harvest's HDIV versus Evolve's earlier QQQY. In terms of stock selection, HDIV relies on the managers picking names, while Evolve's QQQY simply tracks the Nasdaq 100 Tech Index. Both are covered call ETFs focused on tech. HDIV uses 1.25x leverage, whereas QQQY is unlevered. So purely from the angle of HDIV's light leverage, HDIV should, in a bull market, outperform QQQY. But what really happened? We can see that in the earlier years HDIV could indeed keep up with QQQY. Even today the gap isn't dramatic. Yet if we zoom in on the past year, we find HDIV lagging QQQY by a wide margin. Despite HDIV's 1.25x leverage, total return-wise it should have been better. The shortcoming lies in its portfolio construction. HDIV depends on managers picking stocks, whereas QQQY just mirrors the index, benefiting from built-in creative destruction. Now let's talk about the covered call coverage level. Cranking it up to 50% does serve up juicier distributions, but it simultaneously means surrendering more upside. And the upside you're sacrificing may or may not efficiently convert into cash flow. There's a lot of human execution risk baked in. I've said before that Evolve runs a solid covered call play because its managers craft option strategies tailored to each holding. That's the most effective way to do it, and I still believe that today. Yet this hands-on approach has a fatal flaw. It's heavily dependent on people. As I mentioned, people make mistakes. Let's use Evolve's QQQY to illustrate. Yes, it also runs a 50% covered call coverage. We'll compare QQQY with its underlying fund QQQT. They follow the same index, The only difference is that QQQY overlays a covered call strategy to generate cash flow. You can see that before 2025, QQQY's returns were nearly identical to QQQT's. So we expected the same this year, yet we discovered QQQY badly trailed QQQT. The reason is obvious. In April 2025, the momentum index fell steadily until it bottomed on April 7th. Then 2 days later, a full V-shaped reversal hit on April 9th. The index has since logged double-digit gains. No one, except Trump himself, you could say, saw that coming. But QQQY, saddled with a 50% covered call coverage, missed nearly half of that day's surge, creating the gap. Meanwhile, ETFs with smaller covered call coverage like HYLD, whose covered call exposure is just 70%, could still capture most of the upside, so its results remain decent. That's the downside of a high coverage. In extreme scenarios, human missteps tend to magnify the hit to returns. Personally, I prefer a 33% covered call coverage. The yield may be lower, but it also curbs human underperformance risk. A smaller covered call coverage gives you a better shot at both income and price gains. Now let's address 33% leverage. Some might argue if the covered call coverage clips the upside, just add leverage to reclaim it. But 33% leverage may catch up or even beat the underlying in a bull run, maybe even exceed it, yet once the wind shifts it magnifies drawdowns instead. Markets are never only bull runs. There are reflation scares, policy turns, and black swans. Sure, as income investors, these fat payouts let us stomach more volatility than usual, but BIGY's concentrated portfolio, paired with 33% leverage, is bound to test my personal tolerance. When you buy BIGY, you have to be ready for rough markets where the ETF could get cut in half. At that moment, your conviction in the asset will be on trial. My disappointment in BIGY isn't about the payout being inadequate or even the bolder 33% leverage. It's that chasing glossy cash flow makes it ill-suited as a core holding. To boost the yield, Evolve abandoned index discipline, embraced volatility targeting, and leaned further into discretion. Meanwhile, the effectiveness of that 50% covered call coverage hinges heavily on the manager's skill. Entry and exit rules for holdings are fuzzy, so human risk is everywhere. I used to be thrilled when Evolve announced BIGY and was genuinely excited because, judging from its past products, I assumed it would pair 33% leverage with an index-based market cap rank basket and just a 33% covered call coverage. That would have meant a lower payout, but I'd feel safer putting money there. Could have been a long-term core position. The BIGY we got, though, does live up to the big name in terms of distribution size, yet for the 10-year compounding core asset I'm hunting, it's simply not the answer. If you ask whether I'd still buy it, the answer is yes, because it just pays too much to ignore. I'm personally not wealthy enough to forego cash flow, but I'll only hold a small position so it's easy to swap out later. I've talked quite a bit. If you've watched to the end, I hope this video helped you. I'm Old Fish. If you enjoy my content, don't forget to like, comment, and subscribe. See you next time.